Stocks under pressure today. Our guest says we could be in the eye of an economic hurricane. David Sekera joins us now, Chief Market Strategist at Morningstar. Great to see you, David. It's a vivid metaphor here. I think your argument is April 2nd, when Trump announced these huge tariffs, we did see the market sell off. It has rallied since. So we could be in the calm period, but you think more turmoil may be coming?
Exactly. When I just think about the market action, thus far this year, really the hurricane's landfall was when the Trump tariffs, were announced. We saw the big sell-off in the U.S. markets. They actually got to the point where they actually started looking pretty undervalued. The Morningstar price to fair value metric was at 0.83, meaning the markets were selling at a 17% discount to our fair value. So on April 7th, that's when we moved our recommendation to an overweight on U.S. equities. Now, of course, we've had the 90-day pause. Skies started to clear. Everyone's focus has really been on earnings, the past couple of weeks. But unfortunately, I think this period of relative calm, is probably going to be, coming to an end relatively soon. So trade agreements still need to be negotiated. The pause, will last until July 8th. I don't think we're going to see too much in the way of finalized agreements until we start bumping up against that deadline. And then, of course, we are going to have a number of different, disruptions, earnings distortions over the next couple of months. And, when I think about the U.S. economy, at best, it is slowing. We expect that it's going to slow each quarter sequentially over the course of the year. And we think the Fed is on hold for now. So not very good macro dynamics as far as, the market. Having said all that, we do think stocks are undervalued, but I think we need to get through the second half of the storm, until we see brighter skies later this year.
So let's have a look at a 1 year for the S&P 500. You do see a real risk that the market retests the April low. However, when and if this tariff stuff is stabilized, you do see a positive outlook for U.S. stocks?
We do. So they are trading at about a 7% discount to fair value right now. So we are pricing in, some of the uncertainty with everything that's going on with these trade negotiations. But I would like to see a much greater margin of safety from our intrinsic valuations before I move back into that overweight position. So if we do start testing those lows again, getting back to about 5,000 on the S&P 500, I think that's a good time to start more of a small tactical overweight position. And then if the market continue to move down from there, every 3 to 5% down, that's when I think you just need to be able to, have the intestinal fortitude to be able to continue to bulking up into that overweight position. And then, of course, later in the year, as trade negotiations get settled, markets start moving back up, you can lock in some profits to the upside.
The flood of imports into America to get ahead of tariffs has distorted figures or readings such as GDP. So you're very skeptical when it comes to economic indicators right now?
Yeah, this kind of reminds me of that old Peter Lynch, quote. I think he used to say something to the effect of, if you spend 13 minutes a year analyzing the economy, you've wasted 10 minutes. Well, and I think we're in kind of an environment like that right now. In April, our U.S. economics team was really highlighting to investors why you should ignore the headline print for GDP. So in the first quarter, lots of distortions. Lots of companies were trying to front run tariffs. They were just purchasing and importing everything that they could. A lot of distortions in that GDP number, which came out at negative 0.3%. We think the real underlying economy in the U.S. is doing much better than that. Now, of course, thinking about the second quarter, as that inventory gets used up, that's going to artificially bolster GDP. We're looking for a headline of 2%, but we don't think the real underlying U.S. economy is actually going to be that strong. So we are looking for that sequential decline in the rate of growth over the course of the year throughout the rest of the year, really not accelerating until 2026. Our 2025 GDP forecast right now is only 1.2%.
Looking at stocks that have pleased investors, Microsoft, do you reckon it's trading at a discount, a reasonable discount, and that the earnings were strong across all businesses?
Yeah, we actually increased our fair value after the earnings report to 505 per share. Yeah, I know according to our equity analyst team, it's currently one of our top picks. Personally, I think Microsoft should just be a core holding for any portfolio. Everything you want to see in an earnings report, you saw this past quarter. Every single business line hitting across all cylinders. The guidance that they provided exceeded expectations. The star of Microsoft right now is certainly Azure. That's their AI hosting platform. Its capacity constrained and still grew 35%. And we're expecting that growth to accelerate in the second half of the year as new capacity comes online. And most encouragingly, I know management in their conference call just reported that they haven't seen any change in their customer behavior, due to tariffs just yet. So a stock we're very comfortable with at these levels.
And Meta, you reckon a pretty decent discount there, and margin, operating profit margin improving?
Exactly. And I think this is also one of the stocks that's going to be a play on one of our themes here in 2025. Looking for the market to rotate out of the AI hardware stocks, the NVIDIAs of the world that have been, really the stars of the market for the past 2 years, but looking for those companies that are going to be able to utilize artificial intelligence to drive top line growth, as well as to be able to drive, their own margin expansion. And I think Meta is going to be endemic of, one of those, better than expected outlook for second quarter ad sales. We are seeing people rotate out of some of the lower return on ad spend platforms like Snap, and those ad dollars are going into Meta. So a 4-star rated stock trading at over a 20% discount to our fair value today.
And what about Apple? What is your thought, or what's your analysis showing on Apple?
Yeah, I mean, Apple stock is down about 21% year to date. Started off the year as a 2-star stock, which means that we thought it was overvalued. At this point, it's trading almost right on top of our fair value. But having said that, I really don't like the risk reward dynamics here. Best case scenario, you should, as a long-term investor, earn, the cost of equity over time. But this one does have a lot of downside risk with the tariffs. Of course, the iPhone, being half of the company's revenue, generally produced in China right now. So I know they will be moving production over to India over time. But our analysts just noted that, if the current tariffs were to be applied to iPhones, that could be up to 25% downside risk. So that's one where I just don't like the upside downside kind of probabilities here.
And just finally, Eli Lilly, your numbers indicate it's still trading at a premium?
Exactly, and not just a premium, a very large premium, 26% over our fair value, probably one of the more overvalued stocks, certainly in the healthcare space. And in fact, it's so overvalued that it brings the valuation for the overall healthcare sector up, over our fair value estimates, even though within healthcare, we see a lot of other names that we find to be attractive. I think just generally the market's just over extrapolating, too much growth and too much margin expansion on its weight loss drugs. And so now that we're starting to see, some other competition out there. Novo Nordisk announced that with Wegovy, it's now the preferred over at CVS. So we're going to see more price competition, limiting margin growth. So after earnings, we maintained our $650 fair value per share estimate.
And just finally, Amazon, trading at a discount, but there are headwinds, of course, tariffs, all the stuff they bring from China.
Yeah, overall, we like the stock. It's a 4-star rated stock, trading over a 20% discount. But I do think the jury, certainly the market, is still out on this one. So they did beat guidance, in the first quarter, both top line and bottom line. But I know there's a lot of concern about the growth in their AWS business. It was slower than what we saw at it was slower than what we saw at Microsoft's, Azure business. Now, it also has been capacity constrained, but we expect that will accelerate in the second half of this year. They had more one-time costs with like the satellite launch costs. So some of those, I think, are hurting them here in the short term. But overall, we're looking at flat margins this year in our model. So no change to our long-term assumptions. So we maintained our $200 per share fair value estimate.
Thank you very much indeed, David, for joining us.
Thank you.
David Sekera, Chief U.S. Market Strategist at Morningstar. Up next, we are going to look at the housing market through the lens of research from BMO. BMO reckons home buyers have been sitting on the sidelines waiting for lower interest rates, and they may stay there until the economic outlook becomes clearer.